Hello again and welcome. This is Robert Schein, Managing Director and Partner at Blanke Schein Wealth Management. Today is our Friday Insights edition, and we're going to recap the Federal Reserve meeting. They had a two-day policy meeting earlier this week. Markets were disrupted as a result based upon what the Fed said and what they didn't say. So let's get to our Friday Insights, and thanks for watching. So earlier this week, on March 17th, the Fed basically kicked off a two-day policy meeting, and Federal Reserve Chairman Jerome Powell discussed guidance, future guidance, why this is important. And I spent a lot of time today. We're going to go a little bit more in depth in terms of the policy meeting, why this matters, Rob, and why are we discussing this on a constant? Well, Federal Reserve controls the velocity of money. They also control a lot of things in the economy in terms of essentially just think of it as how they could accelerate the economy or they could pull back in the economy based upon what they say, what they do, and ultimately the accommodations that they provide or don't provide on a go-forward basis. So it's really important, and that then really works its way into corporate balance sheets, i.e. earnings, and that's what drives the markets either higher or lower. So we spend a lot of time here basically discerning policy and following the Federal Reserve and listening to what they say. We read their minutes. Our Blanke Schein Wealth Management Investment Committee spends a lot of time going through this. This is very imperative as it relates to how we invest our clients' hard-earned capital and portfolios and retirements investments. So that being said, what did we talk about? What did the Federal Reserve discuss once again? Well, I have it right here. They discussed inflation, quantitative easing, the GDP, and finally employment. And let's start with inflation. They basically say that inflation is, although recently we've seen commodity inflation like lumber in new homes and a few other things across the United States spike up. They believe it's a short-term sort of flash in the pan, not long-term in terms of an economic issue. So they're not so concerned with inflation. One of the reasons why they state is because we have technology. Technology also ultimately is sort of that counterbalance to inflation. But we do see inflation in some of the supply side, right? So as the economy was shut off last year, this time last year, year over year, because of the coronavirus, both here domestically and internationally, as the world dealt with the pandemic, it's one thing to turn say, okay, everyone suspend in place, stay home, shelter, and take care of yourselves. But that then translates into the economy. You can't just turn off the economy like a light switch at home, turn it back on and say, okay, we're going to start, game on again, everyone come out and start, living your life. It doesn't work that way because a large percentage of the US and globally are still frightened because they're still waiting for the vaccine or they're frightened about the new way of life right now. And that's okay, that's acceptable. So in the meantime, the Federal Reserve is a gap stop and really tries to provide accommodation. So, but in the supply side, there's inflation that's hitting because some of the suppliers can't get what they need as everyone comes back out from their homes and starts, sort of getting the economy back on its feet again. And so there's supply chain constraints, and that's really what the short-term inflation readings are. Plus, we also have commodities such as oil. Year over year had a tremendous spike down last February in 2020. And then it was basically now we're at, again, mid-level for oil right now. It's continuing to rise. And that's year over year comps on oil shows huge rise in oil prices. So we're seeing that on the pump itself as the U.S. consumer, and that'll continue to probably persist on the short term. But again, the Federal Reserve doesn't think that's a major issue long term. We will wait to see how that plays out. Quantitative easing. That's a big technical term, but ultimately it's the Federal Reserve providing additional stimulus to increase the velocity of money. Think about in 2008, 2009 when banking system and the whole credit crisis crunch, the Federal Reserve had to step up and basically be the lender of last resort. And when banks basically didn't want to lend to their counterparties back and forth, ultimately the Federal Reserve stepped up and provided that liquidity at that point in time. That was called quantitative easing. Now we're on another round of quantitative easing, and the Federal Reserve is saying, yeah, we're going to continue to do it. And that just adds to the velocity of the money. I brought that up before. What that means is that the more money in the economy, the faster essentially the GDP, which is the next thing. We're going to see more goods and services sort of rotate and swap through. We're looking at a 6% plus on an estimate for the first quarter of 2021 GDP. We shall see. We just came off of the fourth quarter of a 4.2% GDP. And so what they're trying to do is continue to get that GDP to grow again. Remember last year, we were about a $19 trillion GDP in the U.S. economy before we hit a stop directly, because of the coronavirus. Now we're trying to get that growing again, trying to get back to the 19 trillion and maybe the 20 trillion. Now that's important too, because other economies like China around the world are way back, right? They handled the crisis a little bit better. Now their economies are open up, and people are literally going around the world without masks, and as their economies are opened up and the vaccines are rolling out. And so other countries have handled this a lot better than the United States. That being said, we're slow to figure out our policy, but we're don't ever count the United States out. We'll get back to it, but the Federal Reserve is going to provide some assistance and some stimulus that we just saw pass, a $1.9 trillion stimulus from Congress, signed into law, and now those stimulus checks are going directly to the U.S. consumer, about $1,400 plus, depending upon if you qualify. That money will work its way back in the economy. It's going to work its way into the GDP. Keep in mind, the GDP, 2/3 of the U.S. economy is U.S. 2/3 of the GDP is U.S. consumer. So if you give a U.S. consumer $1, they're going to spend it. It's going to go back in the economy. The Congress, the Federal Reserve, policymakers know this, and that's one of the reasons why they really want to get us back on our feet and get America basically greasing the gears to get rolling again. And so that's one of the things that they brought up, and that's one of the key concerns. All of that then will lead to employment. That's their number one concern. So on the bottom, it's the foundational sort of key point to watch whether the Federal Reserve will continue to be accommodative, or if they'll slow, once we get too hot and the economy starts overheating, which we think it will happen this year and long into 2022. That's why we have a positive view on equities. What could stop that? Well, is the Federal Reserve raising interest rates. So they, again, stuck to their policy earlier this week by reaffirming interest rates will be lower for longer, and they will be accommodative in quantitative easing, and they will make certain that the GDP is completely supportive, all anchored by employment. And they want to get that employment number pre-pandemic numbers. Now, believe me, that was sub 4%. And we're plus 7% on the unemployment. So there's a lot of room, at least if you interpret what they say to play out, there's a lot of room for unemployment to come down. It's going to take years. I mean, in 2008, 2009, it took 5 years for unemployment to get back to normal. In 2001, 2003, that recession, early in the 2000s, it took more than 5 or 6 years to get back to employment, normal employment. We're just 1 year into it, and we're at 7% unemployment right now, with the Fed looking at wanting to, they vocalized this, they want to get back to pre-pandemic employment levels. And the reason why is because they believe socioeconomically, that's when it lifts everyone in all different backgrounds and races and makeups and anywhere in the United States. So if you get a sub 4%, according to the Federal Reserve, that's where everyone takes the lift in the economy. And that's when the U.S. is really cranking again for everybody. So that's really critical. This employment is going to drive all of the rest of what the Federal Reserve is going to do on a go-forward basis. Markets are paying attention to that. Now remember, the 10-year Treasury is 1.75, and it really is playing chicken with the equity markets. If interest rates go up, earnings on corporations come down. The multiples come down based upon sort of the cost of the carrying costs and a few other things that are factored in. So this is going to be the play of 2021, 2022. It's going to be a reoccurring theme. I hope I was able to recap sort of the Federal Reserve's thinking here in maybe an 8 to 10 minute little preview of what we're going to continue to be following. And it really matters. As you saw over the last 2 to 3 weeks, the markets pay attention to what the Federal Reserve does, says, and doesn't say sometimes is even more impactful. So this will be continued, and we will continue to report and follow along. But we believe it's going to be a great opportunity that we see anytime markets sell off. We go into high quality, and proactively we like to buy stuff at a discount for our clients, because ultimately that usually works out for the better. And so we don't mind the volatility, we don't mind all of this, but we're going to pay close attention to and stay on top of this for all of our clients at Blanke, Schein Wealth Management. Thanks for watching. Enjoy your weekend, and stay healthy and stay safe.